Hey, good afternoon, everyone. This is Mark from Right Line Trading. I'm just going to give it 60 seconds more because there's a lot of traders coming into the room right now. So we're going to start in 60 seconds. Hey, good afternoon, everyone. Thanks so much for giving me your time this afternoon. Hope everybody had a really happy 4th of July. And I'm just going to start with this disclaimer. And I'm really going to do this webinar right off the charts. And we can take a look at a whole bunch of Forex markets. And let's start with this disclaimer that all signals and trading opportunities provided both orally, written, or electronically are for educational and demonstration purposes only. That Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures, Forex, or stock markets for any profits or losses that may be incurred. It should be understood that a person can lose a substantial amount of money, therefore the participation in these markets is not appropriate for everyone. Right Line Trading is not a registered financial advisor and not a licensed commodity trading advisor. That said, I'm just going to remove the slide. And I'm going to go right to our workspace. Now, just a few words about the Forex market. And that is this. I think it's probably the most missold market that there is between stocks and futures. And it is also, in certain senses, the least understood. To give you an example, I mean, I see multiple opportunities and multiple offers for trading automated systems on the Forex. And I'm going to open, I'm going to take all the questions at the end, but hey, good afternoon, guys. What I wanted to ask is this, and I wanted to see how many traders could give me the answer to this. And that is, why is it impossible? Why is it mathematically impossible to create an automated Forex system? Can anybody tell me that? There's a lot of traders in the room. Can anyone tell me why it's not mathematically possible to automate Forex? Now, you're going to get tons of offers for automated Forex systems, called Forex engines, Forex this, Forex that. That's exactly right, Bob. Yep. Well, we've got a bunch of people who said it, who came in right. And the answer is really simple, actually. If I go to Paint real quickly, it's going to show you that You can optimize for futures, you can optimize for price, and they're going to give you the exact price that you ask for. So there's no problem in optimizing on the futures market. Now in the stock market, for most stocks, you can also optimize for price because the difference between the bid and the ask is extremely small. But in the Forex markets, you can't optimize for price. You can only optimize for the bid or the ask. And the pip spread is too big to allow any automated system to accurately get you an entry. So we've tried to do it on numerous occasions, and we're just about to release our auto trader for Forex. But because of the pip spread and the fact that you can either optimize for the bid or optimize for the ask, but you cannot optimize for price, it creates such an enormous problem that no auto trader can accurately trade the Forex. The spread is what destroys the ability of the system to work. Now you're going to see all kinds of automated offers. Now that is, you get all kinds of offers for all kinds of different things, and I'm not obviously the purpose of this webinar is simply not to talk about all the things that don't work. But I think it's a great example to show you that a lot of the solicitations that you get, especially on Forex, are just plain inappropriate and wrong. And the people that sell them to you know they don't work. Because if they do any forward testing, or less accurately, any back testing, they're going to know right off the bat that whatever they've done in terms of optimization is simply not going to work. If you have a 2 or 3 pip spread, any optimized system is not going to function appropriately. So be really careful with Forex and really know what you have to really know what you're buying. And I think that the more you know about this system, I think the more confident that you will be that it's going to consistently get you winners. Now, I put up the whole chart, and I didn't want to confuse anyone. I know there are a lot of traders in the room who have never seen the system before, and there's some who've seen it on many different things. I chose to display the pound dollar on an 8 range. Now, there is a problem in trading it. We trade futures and stocks on Unorenco, but Unorenco is very difficult to trade on Forex. It's simply because you've got that all the way out here, which is a 1/10 of a pip, and that 1/10 of a pip metric makes any small Unorenco or Renko candle impossible really to trade. So my next best suggestion, since I like candles that are not dependent upon time or dependent upon contracts crossing, is range. And range works extremely well on the Forex markets. So does time. I just chose to show you an 8 range. And I'm just going to go over the system piece by piece and show you exactly why the system takes trades with such low probability and with such low risk. Now, I've configured this to trade an 8 range. I mean, it can be configured to trade a 5-minute or a 3-minute. It can be configured to trade actually a 4-hour. I mean, any time frame that you like. It does not make any difference. But it's based on the same principles that we use to trade the Forex. I'm sorry, to trade futures. And that is that no indicator assessment is done off of price on our trading chart. The only thing that we do to determine direction, determine when to take a trade, is we look at multiple higher time frames, or we look at the multi-time frame direction of other Forex markets. And that assessment of other Forex markets is very, very powerful on the Forex. And I'm going to go over this one by one. And I'm going to start above the indicator system and look at what's in price. Now, this is simply a 50 exponential, and this is a 15 exponential of a 15 exponential. It moves faster. I mean, it moves with a regular 15 exponential, but our exponential is a lot more stable. And it doesn't get jockeyed around by price. You can see this movement up, this movement down, this movement up. R15 stays red and to the downside. It takes a lot more movement to the upside to change its direction. Now, if I overlaid a regular EMA here, you'd see that it will be jumping all around. So what we look for is speed plus stability. Now, the most important indicator on the chart is background color. Now, background color is the multi-time frame direction of the two higher range charts. And what we do is with range, we simply look at the two higher fib numbers. So what we're doing is we're assessing on the 13 range and the 21 range, the 50, 15, and price. We're doing a market structure and trend analysis to look and see when price is down on the two higher time frames. And that's this color. The darker pink is the strongest trend to the downside. Now, I'm going to hold a master class, just one class, to give you a lot of the details I just can't give in this webinar, because there are three down colors. There's this bisque color, there's this dark pink color, and then there's this light pink color. And they all represent different strengths in the downtrend. Now, the sweetest time to trade is with this dark pink. Because price is in a position where it's below the 50, below the 15, the 15's crossed the 50 and is down, the 50 is heading down. On the 13 and the 21 range, you get this dark pink background, and price is almost always going to fall. I can't say 100%, but it's going to fall with really tremendous specificity. I mean, it's almost always going to head down. I'm going to tell you the few reasons of a couple of reasons why it may not, but they're going to be very clear to you. When it's green, that's your strongest uptrend. Now look at this move down right here. The important thing to note is that the background doesn't turn pink because price is falling. Price is falling because the background bias is pink. I mean, in general, you're not used to seeing this kind of analysis. What you're used to seeing is when price falls, then you get a pink background because the chart that most software uses simply analyzes price on your trading chart. So when there's a MACD cross or there's a stochastic cross based on the way price behaves on your trading chart, the background will go green or the background will go red. And all it's doing is telling you what you already know. This is telling you what's going on your 2 higher time frames. And I can go through this. You see, when it's green, price almost always trends to the upside. And when it's pink, price almost always trends to the downside. It's giving you an absolute inviolate direction to trade. Now, we only trade short below the 50 and long above the 50. And in general, you're only going to get green above and dark pink below. Or although occasionally in a wacky market that's moving very fast, you may see pink above the 50 and green below. We know exactly what our trading rules are. And that is we're long above the 50 and we're short below the 50. We want the 50 green and up. We want the 15 up, and we want our background bias up. We want to trade in the direction, in the multi-time frame direction of trend. Now, what happens when there is no multi-time frame alignment? It's right here. And it's right here. And it's right here. Now, let me go back and say that you're not going to get every winner. The goal of this software is to allow you to avoid almost every loser. That's what creates a professional, profitable trader. And I see the guys in this webinar from the Futures Trading Room, like Bob and Terry. They're really good traders. And what they do is have the ability to sidestep losers with the understanding that there are always going to be winning trades that you just can't get in. And that's, if you can understand that and accept that, that's one of the basic tenets for becoming a professional trader. Now, if you look here in this area where there's no multi-time frame alignment and trend, look at what happens to price. It's in total chop. And if you try to trade it in here, the likelihood of getting a loser is extremely high. So when background bias is clear, this is a fairly fast moving market, I can tell you. And we're not getting many areas where there's no background. But you can see right here, no background, no multi-time frame alignment, price just sits and chops. So not only is it going to be extraordinarily powerful in getting you into a winner, it's going to be extraordinarily powerful in allowing you to sidestep losers. And if you've been trading any market, Forex, futures, or stocks, and you're treading water or you're losing money, it's probably not your inability to get winners that's hurting you. It's probably your inability to sidestep losers. That's what always brings down day traders and swing traders. So if there's no multi-time frame alignment and trend, we are simply going to stand down. Now, the premise is this, is that the market as a closed system always wants to move and chop. And it'll move and chop 70% of the time. You know, they're all different statistics, but we know that a significant period of time, the markets will be spent in chop. And then all of a sudden, you will develop a multi-time frame trend. Now, that multi-time frame trend does not occur as a random chance event. It occurs only for one reason, and that is when institutional money intervenes. You cannot get 3 time frames to align in price, in trend, unless there's a substantial inflow of money into the market. So really what we're doing is we're using that multi-time frame trend, and look at this here. I mean, that's an enormous move down. And we're using this as a proxy for the generation of institutional money. When institutional money is selling off the market, it creates that multi-direction, that multi-time frame alignment to the downside. And I'm telling you, this, if you're in my trading room in the morning with the futures, you'll know that this is our key analysis. And when there's no multi-time frame alignment, you're really trading with a significant amount of risk. When you get it, there's a really high likelihood price is going to move in that direction. Now, it's the most powerful analysis we have, but it's not enough to make you successful. I mean, there's things going on below the chart, but whatever's going on below the chart is not going to be enough to help you unless you have this multi-time frame alignment and trend. Now, I want to talk for 1 second about the pivots. Because the pivot indicator is the one that is unique and is exceedingly powerful, and one that we really respect. I mean, right now, it seems like price is walking through the pivot. But most pivot indicators don't work correctly. And this one does. And it's very helpful to never trade into an unbroken pivot. Now, most pivot indicators create the pivot from the wick high, and that is wrong. Japanese candlestick dogma tells us that a pivot needs to be created from a candle body high, and the wick is just not relevant. And you can see right here, when we trade up to the pivot, price is rejected. We trade up to the pivot, price is rejected. We trade up to the pivot, price is rejected. Now, finally, the pivot's broken right here. And you need a 2/3 candle body break above the pivot for this pivot indicator to stop tracing. A wick or 2 or 3 ticks above is not going to do it. Now, it's very helpful to take an entry on a pivot break. Now, if you take this entry or you take this entry, what you're doing is you're stopping out all the sellers in this pivot. And as you stop them out, they're going to help push the move up. So That's what is very, very important. It's something that we use all the time. But our pivot indicator is really different than I think almost anyone else's. Most take the easy route. They simply take the wick high and they're going to indicate to you that they've been broken when simply a tick or a wick breaches them. But that is not enough. You need 2/3 of a candle body to take a pivot out and to leverage all the sellers caught in the counter trend direction to help push your move up. Now, I'm not going to talk too much about market structure, but one in range, you get great areas of consolidation. Now, we have a consolidation indicator I forgot to put on the chart, which is going to show you this. And a trade out of consolidation here is really a great trade. Here's another area of consolidation, lateral movement, and then the break and the move up. Now, why is consolidation? This is a little bit more than I wanted to get into, but why is consolidation so powerful? It traps buyers and sellers in a tight channel. And the buyers and sellers are all sweating. Now, the longer the channel, the better, because you're going to have traders caught long and traders caught short. And what you want to do is take the break of the channel in the direction of the trend. And when you break out of a channel and you've got all these traders caught short, they're all going to start getting stopped out and they're going to zap that move up nice and strong. Now, the first line down below is called our Quant line. And it's really, really a very powerful line. Now, we use it for everything we trade. Now, it's more difficult to create on futures and very difficult to create on stocks. It's the most powerful on Forex. And what we're looking at for Forex, again, we don't care what price is doing on our trading chart. If we were going to take an indicator that simply looked at price on our trading chart, we'd have no predictive value, we'd have no forward-looking ability. We would not be able to tell the direction that price is going to move off the right edge of the chart. Now, this line, and I wish Rory would pick up the telephone, is called our Quant line. And what this Quant line does, good. Now, what this line means is that we're looking at 3 other Forex markets that move either in the same direction as the pound dollar or in the counter trend direction as the pound dollar at least 70% of the time. Now, the correlation coefficient of 0.7 on the Forex is really, that's 0.7 is the level of statistical relevance. It's better to be at 0.9. It's better to be at 0.95. And on the Forex, this is a very, very powerful line, because when the dollar in general sells off, or the pound in general sells off, or vice versa, the pound strengthens or the dollar strengthens, it's going to take a number of crosses in the same direction. So what we want to do is we want to validate our trade with 3 other markets that are either going to move in the same direction or the counter trend direction. And it's a lot easier to do that with currencies like this that have a cross. Now, we're looking for the tightest correlation. And because it's so hard, it was so hard for us to not just determine which markets have a correlation coefficient of 0.7, but which markets are closer to 0.8 and 0.9. I can't tell you what markets are in this quant line. Normally, I'm really very open and transparent about what they are. But you can see that it's not a perfect projection. But what we're looking for is for those markets to give us a long signal and for background to give us a long signal at the same time. We're looking for that alignment. And right here is where you get it. Now, the likelihood now what happens is the trade falls, goes right into consolidation, which doesn't hurt you if you took it here. And then it's almost always going to break out of consolidation short. And now what you have is you not only have background bias telling you that the markets are going to go to the downside, you have a multi-time frame trend in the down direction on the 8, 13, and 21 range. You also have the same situation on 3 other Forex pairs that correlate in direction with the pound dollar. So if you have this pink background, but you don't have this red line, then you may want to stand aside because you're going to have greater risk. And you can see how it quickly turns green. And that's unusual on the futures markets. On the Forex markets, it's not. I mean, these 3 markets swing around fast and the Forex market rises. Now, we cannot take a trade on the Forex because we only go short below the 50 and we go long above the 50, but we have to wait for the 15 to cross and we need the green background. So we have no trade, but if you're looking to exit the trade, it's a potentially great place to exit. And here's another area. You've got those 3 correlative Forex markets, and they just happened to kick in. I mean, you saw it kick in here where there's really nothing, kick in here on a much less powerful up. Here it kicks in on your green background, and up you go. And you see you get a pullback, and then the continuation is long. But you can see the overall trend is up. Now you could take a long. I don't want to go into more specifics. This would be in that one master class that I'm going to teach you. But out of this consolidation, you take a long trade. If you're not in the market on this pullback, you take a long trade. If you're in it from here, depending upon your risk tolerance, you can take this trade all the way to the top. But this is giving you an absolute direction. All you need to do is apply your trade methodology to get in. And basically, we are retracement traders, or we trade out of consolidation. We never chase a move up because there's always the potential that a trade or a market will go into consolidation or retrace and then head up. So we're going to take a trade out of consolidation, or we're going to take a trade out of a pullback, as opposed to just jumping into the trade in the middle of it and just riding it up. So it takes a little bit of screen time, and it takes a little bit of work. But you and I both know that you're not going to trade the Forex markets and make $1 million in a week, like you see in those ads, where one guy says, "I turned $100 into $100,000." I mean, that's not going to happen. But with some education and a really good software system, you can trade this market profitably. Now, even that, look at this move right here. I mean, this is a killer move up. Now, the one thing that I wanted to show you is that here's the consolidation, and there's the break, and there's the move. Now, one thing that I wanted to show you was that it's very rare to take a loser as long as you have background bias dark green and you have the correlative markets in your direction, because they are a tremendously powerful proxy for money flow. The only institutional money can create the multi-time frame trend and swing all three correlative Forex markets in your direction on a multi-time frame basis. So what we're looking for doesn't happen all the time. If you look here, this blue is a fairly strong up color, but you'll notice you don't have any correlative markets. So price is sort of trending up, but you don't get any real lift until you get the green, and then boom, the market goes up. And sometimes, here's the down on the red. Now, again, I want to reiterate that this is not looking at price on your trading chart. If it did, it would have no forward-looking ability. And when you look at a static chart of most software, it looks awesome. Background bias will go pink when price falls. All the lines go red because they're simply telling you what's going on the market you're trading. This background's not looking at price on your trading chart. This is not even looking at your market that you're trading. It's looking at other markets, which is why you need a specific template for every single Forex market that you have. If you look in here, now this is my NT8, and I have all my Forex templates on NT7. But we have 12 templates. Each one has its own quant line because each market has its own set of correlative markets. And let me just take a quick drink. And then I want to go on to talk to you about momentum, which is also really important. Now, the second and third line is momentum. Let me open this up a little bit more. Like, we're not looking to get a lot of trades. What we're looking to get is a lot of winners. I mean, if you take 11 trades in the whole week, which is going to be, you're probably going to get a lot more than that. But the point I'm trying to make is, if you take 11 trades, you want to get 10 winners. You're not looking for a sensitive system that's going to get you into a lot of trades. You're looking for a specific system that when it gets you into a trade, the likelihood of achieving your first target and for it to really run is exceedingly high. That's what's important. Now, line number 2 is the multi-time frame assessment of Leggear momentum. And I just want to talk briefly. I'm not even going to bring up the Leggear slides because I have a whole series of slides on what and how to trade oscillators and how the different oscillators work. We know that there are lots of them. There's stochastic, there's relative strength, there's Williams percent K, there's ADR, ADX, and there are probably ones that I'm forgetting. I mean, there are a lot of stochastic oscillators out there, a lot of oscillators. Now, what an oscillator is meant to do, and obviously this is very abbreviated because I just want to give you a strong feel for what the system is doing. An oscillator is looking at the relationship between the close of a candle and on a long move. Well, I'm trying to think of the best way to put it without the slides. The oscillator looks at price acceleration, doesn't look at price speed. If price accelerates, to give you an example, price is going to accelerate down to here with a certain degree of momentum. Now, it's unlikely that as price falls like this, it's not going to increase in speed. So an oscillator is looking at delta speed or momentum. And it's just like a race car going around a racetrack. If it's going around at 100 miles an hour constant, then momentum is constant. It's not going up or going down. And if you were using an oscillator to look at momentum of the race car, that oscillator would be flat. But as the race car began to accelerate, then the line or the percent K line would begin to rise. Now, what you're looking for in an oscillator is that when price moves down to here, it accelerates down with so much momentum. Now, if it makes a lower low and accelerates then down to here, you would expect it to do so with greater momentum. If it doesn't, then you have divergence. And you're making a lower low, but momentum is not making a lower low. It's making a higher low. So if that occurs, in the old days, we don't do this anymore, but this is what a lot of traders still do, and it's why they get wiped out. And it's also constantly marketed to you as a way to trade, is to take the counter trend move. Now, oscillator, I don't even know if you have divergence here, but oscillator divergence, I'm telling you, from a mathematical standpoint, does not work anymore. And if you try to trade divergent signals, you're really going to get beaten up. Sometimes it will work, but sometimes, or the majority of the time, it won't work. And that's the reason why a lot of traders get, they get hurt. They're taught to trade divergent signals. When a price makes a higher high and momentum doesn't make a higher high, i.e. when price doesn't accelerate as fast up to that higher high, that's supposed to foreshadow a collapse in price. Now, stochastic, Williams percent K, almost all of those oscillators are created to look for divergence. They were created a long time ago, 20 years ago plus, to look for divergent signals, which no longer work. And let me tell you why they don't work. And the reason they don't work is really easy. It's not rocket science when I tell you the answer. Tony, I'm going to answer all the questions at the end, and I see your question, and I'm going to answer everything. And the reason it does it is simply because 10 years ago, maybe 15 years ago, the market was dominated by commercial traders. Now the market is dominated by institutional money. And that's not only true for stocks and very true for futures, it's also true for Forex. Now, I don't think there's anybody. Now, this is a short-term trading chart. We squeeze it, and it's great, but I don't know how to squeeze my NT8 chart because I haven't worked with it that much. But let me see how to do it here. Here we go a little bit. See, if we squeeze the chart, I'm trying to give you an idea of the overall trend, and it's very, very difficult to do on an 8 range. But if we look at the overall trend, you know that a market can stay oversold or overbought, not just for minutes or hours. It can stay overbought for weeks and sometimes for months. So if you're trying to trade a divergent signal, you're just going to get run over and over and over again. That's because the markets don't turn. I mean, the mathematical derivation oversold was meant to be used when the power of every buyer was essentially equal to the power of every seller. When that was the case and the market went oversold, it was likely that the buyers would come in and turn the market up. Now that the institutional traders control direction, they can sell off the pound dollar for 3 months straight. You know that's possible. They can sell it off for a week straight or for 36 hours straight. And all your oscillators, the ones that are geared to give you divergence, are going to give you multiple divergent signals, and you're going to get run over on every one of them. That's why we've eliminated divergence, and that's why also you're also taught to look for tops and bottoms. I'm trying, no matter what happens in this webinar, I want you to learn a lot of good stuff. And I see so many solicitations for trading techniques and the right way to trade a top and the right way to trade a bottom, but you can't trade a top or a bottom because tops and bottoms can't be mathematically quantified when institutional money is at play, and nobody can tell when institutional money is going to step away. All we can do is trade in the direction of the trend, and we want our momentum indicator to be a trend following tool as opposed to a divergence creating tool so we can fade the market in the opposite direction. If we do that, we're really going to get hurt. Now, okay, this is formatted good. Now, what the Leggear does is it's more of a trend following tool. Of all the oscillators, it's the only one, you look at its formula, that's very different than all the others. The others are looking for the close of the candle to approach the high of the candle on a long move, and the close of the candle to approach the low of the candle on a short move. Now, the Leggear is looking for that also, but it has what's called a gamma and multiple smoothing components to it. So it's got a very, very different type of formula. So what we're looking for on the Leggear as an oscillator and as a tool to help us trade is to trade in the direction of the Leggear, and possibly optimally, you can find an area here. Like right here, if you want to take the lowest risk trades, and you look at this trade right here, this is the multi-time frame Leggear. It looks at 2 higher time frames. And you can see that selling pressure is so strong that it's pushed the Leggear down below the 20 line and kept it there on the 2 higher time frames for this entire move. Now that's great, because essentially what you have is price acceleration to the downside. Remember, it's a bounded indicator. So if it's squashed down, you've got so much selling pressure, only institutional money can do that. Now we also have a chart Leggear. It's the only indicator on the chart that assesses, that makes its assessment from price on the trading chart, because we need to trade in the direction of momentum on our trading chart as well. So when you have all 3 of these lines red and you have pink background bias and you're below the 50 like this, the likelihood of getting a loser is extremely low. I mean, I would say that this is the kind of trade where you may lose 1 out of 20 trades. I mean, you almost have 90, I would say close to a 90 to 95% chance of getting a winner when you have the multi-time frame Leggear locked short, you have your chart Leggear locked short, you have your correlative markets all heading down and strongly down with a strong downtrend, and you have a multi-time frame downtrend on your trading chart, and the 50 and the 15 are down. I mean, this is the kind of down move where if you're only looking for a few perfect trades, you know, you can throw in a huge number of lots here, because this is very unlikely to be a loser. Now, I mean, if we look here, you can see you have everything, but look at momentum on your trading chart. It's heading up. So you have no trade. But then when it starts heading down, you do have a trade. The problem is you're trading right into support. And you have to wait for support to break. And when it does break, now this trade does not go very far. And let me just give you another example. Now, the only other thing that I want to tell you is that what we are going to have very shortly is the multi-time frame Leggear only projects a locked long and a locked short. And we don't need that. And what Sergio is working on, and we will have shortly, is when the Leggear, multi-time frame Leggear is heading up, this will be blue. So you're looking for a long, just which has the same probability for a win as a locked green, or it's going to be orange when the multi-time frame Leggear is heading down, but it's not locked red. So there won't be any yellow on the chart, and we'll always know the direction of the multi-time frame Leggear, just like we always know the direction of our chart Leggear. And if I can spread this out a little bit more, It's a little bit easier to assess. Be nice if I knew how to do it. Here we go. So if we look at this trade right here, we wait for the break of the pivot here. And we have green background bias. We have our chart Leggear heading up. We need to know the direction of our multi-time frame Leggear, but in all likelihood, it's heading up. And in the master class, I'm going to show you how to make that assessment. It's really, on a range, it's really quite easy. And you've got yourself a long trade right here, all the way up. So the chart's very intuitive. In here, don't trade. This is a week up. And the long-term Leggear is nowhere in sight. There's no trading here. And your quant or correlative markets are not in sight. Here's your perfect short trade. And you've got red, red, red below. There's the break of the pivot. And you've got your nice short trade. If you just wait for these setups. Now, I want to show you one more thing. The first 5 traders who come aboard are going to get this analyzer. Now, the market analyzer right now is set up for a minute chart. It's got a 5-minute, a 15-minute, a 4-hour, and a 1-day. And you can trade a 5-minute chart. I just showed you a 8 range. These are all completely configurable. So if you want to look at all of these Forex pairs, you can look at an unlimited number. Just don't look at too many, because when you get buy signals, if you're trading a 5-minute and you get a 5-minute buy, pop that chart, because you're going to have the alignment that you're looking for and a likely entry. Remember, if the market is already running up, you got to wait for a pullback and a continuation, or a consolidation and continuation. But it allows you to trade the sweet spots, those areas that I was showing you with green background, and the quant, and the Leggear, all on a multi-time frame basis. Excuse me, on as many Forex pairs as you like. So you are not going to want for trades, and all the trades you take should be in the sweetest spot of the market, where you have every single independent variable that we have created to get you into the trade at the lowest risk. And again, remember, it's all about avoiding losers. It's not about taking winners. I guarantee you, you're going to be overloaded with good trades here. So don't extend yourself or look to take anything less than something that's really optimally set up and optimally configured. So if I just close this, I'm not going to close it. Now, if the Forex markets were actually moving, we would get these colors to change. But you can see they're dead. I have a live feed here, and basically, they're pretty much dead. I mean, I have my FXCM data feed on. Let me make sure I do. I'm 99% sure I do. Yeah, I do. So, I mean, my data feed is active, and the Forex markets are pretty much inert. So I'll show you one more market. We can pick any one of them. Here's our Forex. We can look at the, we're looking at the euro dollar, I believe. We can look at why don't we look at the dollar yen? Here's the dollar yen. Now remember, it's just as important to stay out of a trade and chop and have the software define chop as it is to get into a trade in a trending market. And you can see here, there's no chance they're going to take a trade in this mess. There's no alignment of anything here. Now you've got the green, but look at your long-term Leggear, it's yellow. There's nothing here to trade. And here's, I mean, you finally get a setup. It's not a great one, but you get the entry here. You get the pullback right here. You got to wait for the turn of your chart, Leggear. Unfortunately, this is a choppy market, and there's your long. It's not a big trade, but this is a very, very choppy market. And there's your short right here. Eventually, the market's going to come through. Now, it depends on how far you roll this trade is totally dependent on risk tolerance. As long as background stays pink or light pink, you can take the trade lower. You can take an up candle and exit on the trade. The automated trade management strategy that you use is really dependent upon how much risk you want to take. What we're looking to get you is very low risk entries that are very, very likely to move in the direction that you want them to move. And if you take, this is a small area consolidation. It's only 3 candles, but it goes down, takes a little bit of a retracement, goes way down. Now maybe you're going to take it out here, but you can't re-enter here. You really couldn't re-enter the trade till here. And then you could take it down. So you've got yourself a great entry in a great trade. And where you take yourself out is totally up to you. And then where you get back in, you need that perfect alignment. But you can see the trade's right into resistance, retraces, and just does not give you a long trade. And here's your long trade right here. It's going to give you heat. There's your break. It's going to come back right to support and then shoot up. Now, right here, there's no reason to take it out, but it just goes sideways. And then the market's going to fall. And depending again on your risk tolerance, you lose green background very quickly. So, okay, you want to look at the Euro Aussie. We'll dial that in. Forex. I'll have to go to the instrument manager to put that one in. Hang on one second. I don't know why that's not in that list. Hang on one second here. EUR, right here, Euro Aussie. Here's a move down. Another move down with everything right here. Look at the Leggear on your trading chart. It's heading straight up. No trade. Here you have no multi-time frame Leggear. Here the Leggear on your trading chart's heading down. Just don't have a trade yet. And there's your trade. Now this is a tough trade because you're going to get a break of the pivot here. This is a really tough trade. You'd expect this to run, and what you do is you get a pullback right to resistance and then the run. So if you want to wait for that pullback to that 15 and then the continuation short, you can. But the overall direction of the market in this situation is down. Here you don't have any alignment of the multi-time frame, and you don't trade into this unbroken pivot. Here you really have nothing. Totally protects you here. Here again, it's a choppy move, but it's a small short trade. Another choppy move, but it's a small short trade. This is a better short trade because it comes out of consolidation. I'll tell you one thing, you will never be caught in the wrong direction and down. Here, nothing. Not much, but the separation between the 15 and the 50 and the 15 is wide. And I'm going to go into that in the master class. And here's where you start getting your nice long moves. You see the three greens? Green, green, green. Well, all you're going to do is look for a pullback to support and the move up. You get a nice move. You're out, pull back to support, and a nice move up. Now this doesn't go very far, but these are eight. This is an 8 range. This is 8, 16, 24, 32. This is 32 pips. I mean, that's a nice move. Same thing here. Consolidation, break, and move up. Now you get 3 or 4 of these off of this, and you'll make really nice money in the course of a day because you're going to avoid a loser. Now, this is a tough one, I have to tell you. Except the best thing to do as you'll learn in the master class is wait for that pullback to resistance and then the continuation, because you can always get it in a downtrend. Now, the thing I want to add here is that there's always going to be traders trying to trade in the counter trend direction. And this is what we have to be careful of. What are they trading? They are trading oscillator divergence, MACD divergence, maybe they're trading Elliott wave, and maybe even they're trading off of Fibonacci support. Now, I personally don't believe in any of them. I mean, I think that fibs don't work. I think that occasionally they do because they're, it's sort of a self-fulfilling prophecy. At certain fib levels, you have enough people watching them that they're going to turn at that level. But Mr. Fibonacci, who was a brilliant mathematician, created those levels 400 years ago. And why anyone thinks they would describe the movement of price in the market in today's environment, I think is nuts, personally. And the other thing I wanted to mention is that Japanese candlestick patterns have also lost their power. Certain patterns, though, are terrific, and that's the consolidation pattern, which is terrific. Now, I have the indicator, and I'm not going to bother to put it on, but it's going to show you these channels. And let me see, and this is the kind of setup you're looking for right here. I will show you how to confirm that the multi-time frame, this middle line, is in your direction, but you have a break and a run. If you want to wait for the pullback to support and then take the trade, That's the best way to do it. If you want to wait for consolidation and take the trade, that's another way to do it. I'm going to show you the best entries, but this price is going to rise, and that's 90% of the battle. All you've got to do is find an optimal entry. Okay, let me look at one other market. The euro pound. I just don't want to take this out too long. The euro pound, I'll be happy to look at. Let me find it here under Forex. Here it is. You know, all the markets are going to behave the same. They really are. I mean, you're not going to know the difference right here. It's a great move to the downside. Now you're going to exit at the pivot. And you get all of this chop, which you don't even touch. Now this is a weak up signal, and this is a weak up signal. So this is a little riskier to take, even though you have the Quant, the long-term Leggear, and your chart Leggear. You can take the trade, but it's not going to flash on the analyzer because you need green background for that flash on the analyzer. Here you don't have the multi-time frame, so you have no short trade. And here's your great trade right here. I mean, you just got to decide where to get in. You can get in on a consolidation here. This is a terrific area of consolidation. I mean, you don't get a huge move here, but boy, this just mashes these pivots. It bounces here, but that's where you close the trade. As long as you're guaranteed your first target before you hit the first area of support, you're good. And the way I manage the trade, I really don't want to go into trade management, is if I've got a trade like this and I'm tight to a pivot, I'll take my first target, move it a tick or two or a pip or two in front. As soon as it hits, I can either do one of two things: close the trade or bring my stop to break even. I've locked in my first target. If it bounces off the pivot, I don't lose anything. And if it happens to break the pivot, I make more money, and you can do the same thing here. You now lock in more profit. If it bounces, it's going to take you out. If it breaks it again, you're going to make more. Here, it didn't break, but those are all trade management issues. And here's another move to the downside. It's really just a matter of finding an optimal entry. Here, no trade. Here, really nice trade. But again, you're in multiple areas of resistance here and here. You have to be very careful. So let me just go to the last market, and that's the pound Canadian. And then I'll answer any questions. Now, let me just go up here. And that's the GBP. I hope I put that in one right. That one in right. There it is. See how I mean, these are the areas that you want the software to define for you as being areas that you don't want to go near. Anything that you try to take here, it may work for you, but you know, the one thing I do at the end of our trading session is to see if I made money on bad trades, and you can do that. Nothing should be taken in this area, nothing. And there's your move. It's certainly not a good one. I mean, not a big one, but you know, any winner is a good winner. And this you can take right off support here and then up. Now, if this stops you out, You take it back off support. Another trade. Up. So have to be careful here. I'm going to teach you, depends on what you trade. If you trade range, your formations are going to be different than if you trade Unirenko, than if you trade time. This trade's great on a 5-minute. I just felt it would be nicer to show it to you on range, but here you're just not going to trade. If you look for an entry right here on a pullback, it's a tiny winner. It's about 15 pips. Here down below, you have no validation of the trade. I'm telling you, it's hard to pull in a loser, and there's your winner. And so I'm telling you, it behaves the same way on every single market. And if I hid this, you wouldn't know what instrument it was trading. It's simply some of them are going to have a lot of volatility and a lot of volume, going to give you more entries. Others have less volume and less volatility, will give you less entries. Ultimately, if you have the analyzer, it doesn't matter. You're going to, depending on what you trade, this could say 5 range, 8 range, 13 range. You're going to look at the 8 range column. When that's green, you're going to look for a trade. If you're trading a 5-minute, if you want to swing trade, you may want to look at the 4-hour because you're going to set up a 4-hour chart. If you really want to ultra swing trade, you can look at a day. You can configure this any way you like. And we do all of that for you. We do 100% of the configuration. So before I answer any questions, let me just show you the offer that we're going to make. That's the wrong slide. And I'll show it to you. Now, normally it's $29.99. Now it's $13.99 lifetime license. Now, what I didn't put in here is that you get upgrades for life. And we're going to do a lot of upgrades. You're going to get that intermediate color on the long-term Leggear, blue for up before it's locked long green, and orange for down before it's locked red down. And we have a whole bunch of upgrades we're looking to do. And the first 5 traders also get the market analyzer, which is going to be very helpful for you to find winners if you want to trade multiple markets. The offer expires on Sunday, the Sunday at midnight. Our number 786-732-4656. And we've got somebody on the phone 24/7 if you want to call us. So let me go back and look at any questions that you have. Okay. That's right. Okay. Steve, I mean, I don't like Renko, and the only reason I don't like Renko is it totally obliterates price action. I mean, I personally, if you look at range, you can see consolidation. You can see an engulfing candle. These are all things that are still valid today, especially consolidation. So look at this trade. Now I'm sorry I don't have the software up, but the traders in my trading room know we have the indicator. See this area of consolidation? Now, it's not a trade, but you see how powerful the move up is? If you trade Renko, you're not going to see any of this. And all this is doing is telling you something really simple, but very powerful. And that is, you've got traders caught in the counter trend direction. 2 red candles, 3 green. Which way is consolidation likely to break? It almost always breaks into the trend. And up it goes. And what helps propel it are all the sellers you're stopping out in this area. So why give up that information? And you do give all of that up when you trade Renko. So that's just my personal bias. I'm not saying that you can't trade it successfully. I would just like to see that information. So that's why I oh, David, I didn't scale any of them. Here, scale one of them for you. Let's see, you're going to be in one tick above the close, which is too rough here. Okay. No, what I'm saying, Lawrence, is that the assessment of the color is done by the higher time frames. So if you look at if you look at most software, the background color is assessed by price rising or price falling. If price rises here and the two higher time frames are not long, you won't get any green background. And if you look right here, see this price rising here? You're not going to get any green background here. So price rising, see this price moving all the way up here? Doesn't change background color. Because, and look at this big move up here. Background is clear because the background is created by the higher time frames. So you're going to trade your chart into that higher time frame color. Now you've got to wait for it to evolve. So that first candle, and you see you've got red, red, red across the board. So you just have to wait here for an entry, and maybe you won't get one, but you do on a break of the pivot here and the move down. So you can't really anticipate when pink is going to occur. You got to wait for it to print, and then look down and see if you've got the triple reds. If you've got it, you're looking for an entry. You see you've got two areas of support that need to be broken. Let them break, and then take the candle to the downside. You know, it's just a matter of which comes first, the chicken or the egg here. And in this particular case, the background bias is really the chicken. I guess that's a bad analogy, but that is what tells you the direction to trade your chart. And the direction of your chart in no way affects the background color, because you can get large price moves to the upside on your chart and not change that background color at all. Those are Unirenko, Tamir. I had it on 5 minute, but I thought it might be easier to show on a, the 5 minute works terrific. It really does. And the JPEG that I put on one of the invitations was the 5 minute. And you can see that the analyzer is set for a 5 minute. So I really like the 5 minute to trade on Forex. You're going to get really, really nice trades and really nice alignment. What I really wanted to do is just show you the principles that the software is based on. It doesn't matter the time frame that you use to trade it. You can trade it on a 5 minute, a 10 minute, a 1 hour, a 2 hour. You can trade it on an 8 range, a 5 range, You can trade it on a Unirenko. It doesn't matter. These are universal forces that move price. When you get a multi-time frame alignment and trend, when you get the correlative markets, and when you get price acceleration to the downside, it doesn't matter what instrument you're trading, in fact. This is going to do the same thing on futures. It's going to go do the same thing on stocks, and it will do the same thing on Forex on any time frame whatsoever. It does not matter. And if a platform is really doing an assessment correctly, it should be time dependent and instrument dependent, because every market is moved by the same forces. They're all the same closed systems, and they're all moved by one thing, and they're moved by money. What else moves the market besides money? Nothing. So what we're doing is we're using what we believe are proxies for big money, a multi-time frame alignment. I'll look at the correlative markets and the continued acceleration or really profound selling pressure on multiple time frames. So it doesn't matter really the time frame or the instrument. You're going to get fewer entries on a 5-minute, but you're going to get bigger trades. And you're also going to get, but if you have the analyzer, you're going to pick them up. No, Tonyston, that isn't true. The analyzer is not going to get you in late. And I'm telling you, if you look right, I mean, here's a really good example. If you're trading this chart only, and you're doing it on an 8 range, right here is where you get your signal. You go ahead to go short, but you can't, because you're trading right into support. So you got to wait for this candle, this candle, this candle, this candle, and then this is your entry. So your entry is rarely on the first pink candle. And if we take a look here, remember, you can't chase this trade up, because you're always going to get sellers trying to push this in the counter trend direction, doing crazy things. So you're going to have to wait for one or two things: consolidation, and then the move up. And this is what the master class is all about. You see your entry, now you see the area you want to take a trade, now find the entry, or a pullback all the way to support. You're going to have plenty of time to find that. I mean, this is no trade. It goes right into a pivot. Here, you just don't get a trade. I mean, maybe you're going to get a trade here, but I think the trade's mature at a consolidation here. You have to be, listen, you want to make the market come to you and give you the best trades possible. Here's the great entry, because it's a pullback into resistance. You don't get that with the pink, and the trade's already pushed down. So you just got to wait. That's all I can tell you. And this is not going to jump past you. And here is a terrific, I'm going to show you. Here's your whole area of consolidation here. Now remember, I have an indicator that shows you. So you get the break here, but you need 2/3 of a candle. The clean break is right here, and you've got your short trade. And you're going to have plenty of time to get in them. You really are. Right here, when it goes pink, can't use that candle. You got to go in on this one. So if they're not going to skid past you, especially the Forex, I mean, this thing is not moving at breakneck speed. So I wouldn't worry about that. You don't go in on that first pink. The first pink is okay, time to trade. Look below, I'm going to show you in the master class how to trade that yellow and look at the longer term time frame Leggear. Eventually, we're going to code it right in, so you won't have to dig for it. And then you've got your short trade. So it's not going to happen, Tony. Tamir, I like the 5-minute a little bit better, except that the reason I wanted to show the range is because of the fact that you get more price movement. And a 5-minute, maybe we'll give you 1 or 2 entries on a given market a week. But if you're trading, I recommend trading on a 5-minute trading 12 markets. And if you do on the analyzer, you're going to get great entries on 5-minute entries, and those things are going to rock. So I just wanted to explain the principles of the system on a fast-moving chart that doesn't give you big moves. It gives you small moves. But if I was going to trade the Forex tomorrow or Monday, I would use a 5-minute. And the analyzer on a 5-minute is a real killer. Just this green. It's all you need. And you see how a lot of these pairs give you the greens at the same time. The New Zealand yen and the New Zealand dollar are green. There's another New Zealand. That one's not green. But a lot of these are going to signal at the same time because they're correlative markets. So you're not going to have too few entries. You're going to have there are going to be times when you have too many. So this has 1,000,000 pairs on it. I just recommend 12. Your 12 favorite pairs, and that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. That's about to here, and that's all you need to get great entries and more than you need on any to trade and get plenty of winners. Satan, I'm not sure what you mean by you won't know that at the start. You're gonna have to. I want to answer your question, but I'm not sure what it is. Leon, it's really easy to. Every price turn creates a pivot, and that's something that's better to go into in that master class. But see prices heading down, it heads up, it creates a pivot. Actually, there's a pivot here too. Now, the thing is, I set the pivot sensitivity indicator, as you know, at 150. So I only want to see the large pivot swings. If you want to set this to 50, it's going to give you a lot more pivots. And if you set it to 25, it's going to give you even more pivots. And the fact of the matter is, every single change in direction is a pivot. And it just depends on how many pivots you want to have to deal with. What are the ones that are critical to trading? And I believe you see that best on a sensitivity of 150. If you would like more pivots, you want to trade with a little more specificity, you can change that. You can change that sensitivity. And if you drop the sensitivity way down, you're going to get 1,000,000 pivots. So you can get the little ones here. Now it's not looking at a pivot here, but you're getting this one. You're going to get a lot of pivots. And maybe that's your style of trading, and you'd like to see more pivots. It gives you that ability to do that if you want. I don't see that, Tamir, but I'll be happy to go over it with you. It's not, Ian, because these colors are going to change. I mean, this is what I use to trade the futures market. I never have trouble trading these in a live market. I mean, sometimes they will not go red for you in time. In other words, the trade will start down and you don't have them, but you just can't trade them. I mean, those are trades you just can't take. You have to wait for everything to align. The issue really here is the bands are going to come in when they're going to come in. You have to wait for them. And they're going to be, like I said, winning trades in which you don't get them. And I'm sure I can find winners that don't get them. And Tamir, listen, 8 range is very choppy market. I'm sure I can find a really big move where you just don't get them. See, this you do get them, and you have background. You're going to see winning moves where the bands don't come in, Ian, but you have to let those trades go. Remember, you're trading with specificity. You have to wait for all three. You want to wait for the quant line to be green, your trading chart Leggear to be heading in the direction you want it to be, the long term to be heading, background bias to be correct, price to be above the 50, the 15 and the 50 green. That's specificity. If you want to avoid losers, that's the burden you carry as a day trader. But if I think if you're referring to trading bands in real time as tough, it's really not. I never have trouble doing this on futures markets. And let me tell you, I trade the NASDAQ, which is like I don't know, sometimes it breaks the sound barrier. It moves so quickly. And these are the same lines I look at on the NQ, exactly the same. I look at the dual Leggears and I look at the quant and I look at background bias. It's my major signals. And if I don't get what I want in time, I let the trade go, because there's so many opportunities I'm going to get that I don't care. And that's going to have to be your attitude, because it's never going to align exactly for you every time there's a winner. It's just when you do get the alignment, the entry then when you take it is a very low risk trade. And that's all you want. That's all software can do for you, is point out the lowest risk entry opportunities. It's all it can do. It is recorded, George, I'm sorry. Sure, Paul, if you want it, you let us know and we'll do it for you. I just put the 8 range in Robert, just because it's well understood. And the Unorenkos that we trade are not so clearly understood. It doesn't matter the candle formation. It does not matter the time frame. It'll handle anything. Does not matter. I just wanted to, for people who have never listened to me give a lecture, I didn't want to have to go into Unorenko metrics. That's all. Does not make any other difference. You're right, Tamir. These are small moves, but this is a very fast chart. And I would not, normally I wouldn't trade an 8 range. The only reason I projected it was to show you the principles behind. And we could go to a 16 range easily. And I'll do that. Let me go to the, a second here. I go to the data series. We can go to a 13. Now a 13 is going to require a change here to 21. And a change here to 21. And these are bigger moves. But because now you're trading a 13 range chart. But the same principles are going to show. Only you're going to get fewer trades, and when you get them, they're going to be bigger moves. Down like that. Everything else is exactly the same. You go to a 21 range or a 35 range, it doesn't matter. We're still, you know, Tamir, because I had Sergio do the Russell template, it set him back. But we're going to do, he should have the automated out next week. Hey, Philip. Oh, God bless you too, Philip. I have nothing from Gary. The last time I heard about Gary, he was just he had so many medical problems. I just kind of felt bad, and I thought I would let him call me. I mean, I'll probably, you know what? I'll give him a call this weekend and see what's going on. Tony, I sent it out. Let me see if I can find it. In the trading room, year to date, we're up 17,000 and change in the futures market. Now it's below our projection. We should be up 24,000. I have them all on a JPEG. I just copied and pasted right off of our NinjaTrader. The reason I can't show it here is I don't have the right data feed, and it's not going to project. And also I have NT8 and I'm trading. Well, it may show the same on NT7. I just don't have the right feed up. But I just downloaded it and sent it out, and that's what it is. It's around $17,000 year to date in the live trading room. I think, and that's about 500 trades and change. Most of them are 2 contracts. So that's how much we've made so far. Now we're looking for $1,000 a week. We did it last week. We do it most weeks. So if we had done it every week, we'd be up 24,000 because we're about 6 months in. But I think we can make it up. Oh, thank you, Ian. I really appreciate coming aboard. Okay, Robert, let me show you a 4-hour chart. Let me go to the data series. Go to minutes. It's 240 minutes. Now I got to load a lot more data. Oops, that's not it. I'll load 30 days data. And what I have to do, it's recalculating everything here. Let's give it a minute. All right, now these, I have to reset those. I'm just gonna go to the pound dollar. So I think that has the most volatility. Let me just change the instrument, let it recalculate. And also I want to remove all the drawing tools, or drawing objects. And let's just give it a chance to recalibrate. Okay. Now the multi-time frame has to go to minutes. Now I have to calculate it because you've got to take 240, multiply it by 3. It's 720 minutes. And now I have to go to the Quant and also see the Quant Sergio is working on still doesn't have a minute input. I'll try here. That's still too short. Hang on. It's still too short. Hold on. All right, I can't configure the Quant just yet. We're gonna have to hold on the Quant, unfortunately, and trade off the Leggears. And really, this is the only thing I can show you right now, is this move down right here. I'm sorry about that. You can see the trading Leggear is heading down. The multi-time frame is heading down. Now the two inputs I can't yet go that high on, but they will be that high when you're going to get the software on Monday. You'll be easily be able to configure your background and your quants to 720 minutes. I just can't go that high yet. So this is the 240 minute, and just based off the Leggears, and my guess is you're going to have your background bias and your quants, although I can't give you a guarantee on that. And Sergio's working on changing that input higher now, because we have people text us that or email us that they want to trade dailies. You're going to have this move down here, and you might have a move up here. I don't know. Here's the multi-time frame Leggear, and it's accurate. Here's your chart Leggear, and that's accurate. There's your pullback to support, and there's your move up. Now, unfortunately, I can't validate this for you with background yet, and I can't get the Quant up that high. The three correlative markets, I still can't push up that far. That number will not go up that high, but it will when you get the software. So that's your and I can't do the 1 day yet, Robert. I'm sorry about that. If you want to give me a call on Monday, I'll be happy to show it to you. Believe me, it's gonna. I think you're gonna get great trades. I mean, you've already got both Leggears here down, and here, right here, you've got both Leggears up. Right here is your perfect trade. Unfortunately, it's into a pivot. Got to wait for the break. You're into another pivot, but I still think I have a pivot sensitivity indicator too high. Let me go back and change the pivots, because the pivot indicator should be a 150. And this is what happens. Hang on one second here. It's a 25. So you see the pivots are gone. So you have I'm pretty sure you have a trade here. I can't guarantee. Now you have the quant, but it's not set high enough at a high enough speed. And the background I can't get, because it's also, I can't set it to 700 and whatever minutes it would require. Frank, those are futures. You can trade the 6C and the 6B for sure, but you do that on the futures platform. You would need a separate data feed to get the dollar euro and the pound dollar. So you can trade currencies, but those are futures currencies and not Forex currencies. I don't know what you mean by the outcome of the trade at the start. I mean, I'm showing you the whole trade here. I mean, this is why I've really taken the webinar off of this. I mean, 90% of webinars are taken off of stylized JPEGs, where they really don't go to a live chart, or they go to market replay, where they know you're gonna see, where they know what you're gonna see. I mean, I'm looking at any market you want on any time frame you want. So I don't really understand what you mean, honestly, by the comment, because I mean, you get to see the market and see how the indicators behave. I mean, this is as much transparency as you're ever going to see. Hey, listen, I totally agree with you. And what Satan wrote is that, you know, the big sharks chase out the little fish. Here's what we do though. We're trading with the big sharks. These are all proxies for institutional money. When you get a multi-time frame alignment in momentum, so much so that selling pressure has squashed it to the 0 line, max 20 line, and it stays down, and you get your chart Leggear heading down like this. Now it's unfortunate I can't do the quant and background on this higher time frame. We're trading with those big sharks. The big sharks, what they're looking for are for these traders going long. These are the little fishes they eat up right here. And we love these fishes because we eat them too. Because every time we get a long move in a short trade, it's going to help us push the trade in our direction. So we are never, just excuse me 1 second, it's my son, I'm a single dad, give me 1 second. Okay, my son is away for July 4th, and it's just me and him. So we're going to make sure. See, look at all these traders in these green candles. They're the little fish right here, and look what gobbles them up. This move down. We're going to be in that move down. So we are not trading with the little fish. We're going to eat them too. And that's what makes this platform so effective. We're trading in the direction, really, like I said, the only thing that moves price is money. And the only indicators that are effective are the ones that are good proxies for the direction of money flow. And these are great proxies. A multi-time frame alignment only occurs really when big money's involved. Momentum, the quant lines. So you have your 3 correlative Forex markets. Those are all telling you the way that the big traders are taking the market. And when they don't align and there's nothing but little fish swimming in the pond, we are going to step aside. We'll let them devour each other, wait for the big shark to come in and trade with the big shark. And that's the only way to trade. We don't trade divergence. We don't trade tops. We don't trade bottoms. Only the small commercial traders try to do it. The big institutional traders create them, and we can't ever anticipate that. Sensitivity, Leon, is true positives over true positives plus false positives. It's essentially, it's a mathematical formula that tells you if a trade is going to be successful, what percentage of those successful trades you're going to get. Specificity is if the trade is going to fail, what percentage of those failed trades are you also going to be signaled not to take? So there's always a trade-off. If you try to get every winner, you trade with 100% sensitivity. If you try to avoid every loser, you trade with 100% specificity. So it's kind of a trade-off, but you gotta lean towards trading with tremendous specificity because your number one goal is to avoid losers and not get winners. Thank you so much. Terry writes, over the years, I have studied all the information and turned myself into a good chartist, but couldn't trade because of emotion and fear of loss. Your software has taken away the emotion, and the time in your room is invaluable. Thank you. Terry's in the room every morning when we trade the futures markets. Terry's a really good trader. Thank you, Ian. Thank you so much. Ian's purchased. Are there audio signals that can be turned on when watching multiple markets? By the way, I trade futures, not FX. Paul, if I turn off all the audibles. Most of these signals are audibleized, but if there's an audible alert that you'd like us to make for you, we'll be happy to do that. I mean, we would do that for you for no charge, because all Sergio has to do is put in an audio file for you. And that's real simple. So if there's something that you want to see that gives us a beep, you just let us know, and we'll make it for you. We've got already so many beeps and bongs in there that I turn them all off. But if you want one, we'll be happy to do it for you. It's just about ready, Leonard. And let me tell you what I'm going to do. If it's not ready by Monday or Tuesday, I'm going to release it separately, so you all have it, and you've got the consolidation indicator because it's a great indicator, and I want you guys to have it. I know, Terry. Sergio's finishing it today. It'll go out this afternoon. It turned out to be so much more work than it was, and he's doing a new template for every single NT8. Thank you, guys. Thank you. No, Frank, your kinetic will not screw it up as long as you put it in as a secondary feed. And if you have any questions about that, just give us a call and Sergio can help you, or Rory can. As long as your CQG or continuum is primary and kinetic is secondary, it will not screw it up. No, Steve, you can go to a day. I mean, you can trade weekly. Like I said, Sergio's modifying the input, so you can go as high as you like. For some reason, we have a cap on it. But when you get the software on Monday morning, which is when we would configure it for you, you're going to be able to set it as high as you like. And it does not affect the fundamentals. Like I said, these are not time-dependent fundamentals. It doesn't matter whether you trade daily, weekly. I've never seen anyone trade more than weekly, but we have a lot of guys. Most of them are overseas who trade daily signals, and they're in the trade for a long time. So you can do anything you like. They're not, believe me, these are not time dependent. Thank you so much, Mercedes. Together with pattern analysis is magic, in my opinion. Very good presentation. Thank you, Mercedes. Steve, if Terry said something bad, would you have said, it's okay, Terry? It's a hey, I read bad. I read bad comments, Steve. I swear I do. I do. Hey, thank you, guys. All right. Well, listen. Thank you so much for giving me your time. This has gone way over. I started at 1. It's 3 o'clock. The software works. It has really nice precision. We're up a lot of money in the futures day trading room. And like I said, I will do a master class with you. It'll probably last 3 hours. And we're going to go over all the trading signals. And when we do that next week, we will be able to configure it for any time frame, as high as you like, for 4 hour, 8 hour, daily. And we'll also, I'll show you how to configure the trade analyzer, which is really, really a nice ancillary tool if you want to watch 12 Forex markets. All right, so listen, guys, have a great, great afternoon. Have a wonderful weekend, and I hope to see you on board. And my goal is to help you. It is to help you be really, really successful traders. Take care, everybody. Bye-bye.